All right, in this problem, we're looking at the Chapter 4, Problem 58, Comprehensive. This is a cost method. Go ahead and pause the video and look through everything here. There's a lot of information, and then we'll just dive into actually working on it. So the first thing we need to do is figure out this goodwill. I didn't give it to you this time, but we have the excess paid over book value, and we have the breakdown of AAP. So it's not too hard. We'll just say equals our excess over book value minus the sum of our allocation of the AAP, and that gets us goodwill of $185,250. Then if we come down, the first task is to just document our AAP activity. So I'm actually going to go ahead and pause the video and just fill this in, and then we'll make sure that we all have the same numbers before we move forward. All right, so now we have this filled out, and you can just go ahead and do a double check and make sure that we have the same thing. And what you just see is that we have the balance for the beginning of the year for each of these AAP items, as well as the end of the year, and also the annual depreciation amortization that's going to take place. So we have that information ready. This part B, we're really just kind of like transferring information down, so it won't be all that crazy. First, we're just going to go grab the intercompany sales. So we have 65,000. We'll copy that right to get the 52,000 for the 2021. Then we're going to get the ending inventory downstream and upstream. And so we'll start here. And we have 39,000. And then we can, there's really nothing for the upstream for 2022 and nothing for the downstream for 2021, but you can copy the formulas and just fill that information and leave those as zeros. Then we need to actually calculate the profit on that. So it's given to us that it's 28%. So we'll say equals, and we'll grab that 39,000 times 0.28, and then we can copy that right and copy down so that we now have the profit calculated. And then we'll go get the unpaid invoices amongst each other, the accounts payable, receivable. And so we'll copy that down. And again, this was more so just like a translation of information further down. The only real calculation was here where we were calculating the profit percentage. Then we need to look at the building, the intercompany sale of the building. And it looks like my blues are off just a tiny bit, so I apologize. I'm not exactly sure what happened. What I might do is just cut these, move them up one. Okay, that looks better. And so we can just pull this information also down. The intercompany sale was 130. If we pull it down, we see that the pre-sale carrying was 104. And if we subtract those from one another, we get a gain of 26,000. Then we can go grab that useful life, which was 8 years, I believe. Yes, 8 right here. And we can then calculate that we are going to confirm $3,250 every year. So now that we know that information, we're able to figure out the unconfirmed gain at the beginning of the year and the unconfirmed gain at the end of the year. And so to do this for the beginning of the year, at this point, only 2 years have passed since the date of the sale, since it was 2020. And so we will take our gain of 26,000 and then subtract out, I'm going to put in parentheses, the amount we're confirming each year times 2 years that have passed, close parentheses, and we get 1950. Really the exact same formula for end of year, just at this point, at the end of the year, 3 years have passed. So I'm going to click into the formula bar and copy this, and I'm doing that so that when I paste it, it doesn't pull the cell referencing down. We'll change this to 3, and so we have a beginning of year unconfirmed gain of 19,500, end of year unconfirmed gain of 16,250. Now the last thing we're going to do before we actually post into the CD entries is calculate our adjustment. And so we'll start out by looking at our change in retained earnings. So we'll say equals, we'll get our beginning of year retained earnings, subtract out the acquisition date retained earnings of 152. Then we'll go grab our cumulative AIP. I'm going to say equals negative sum. And, oh, this was already in the negative, so I'll take that negative sign out. But we need to add these 3 years that have passed so far all together. So let me take that negative sign out, close the parentheses here. Okay, so we get negative 35,425. Then we need to subtract out our beginning of year upstream intercompany profit, which we can see. We already calculated the profit part here, so we'll just take the 7,280. Then we need to subtract out the downstream unconfirmed asset, and so that's this 19,500 that we calculated. And when we add these together, we see that our adjusting entry needs to be 110,045. So we'll go ahead and do that first. Now we have 110. And now we can really, again, just like kind of dive into that traditional normal CD process. So we'll do our income from sub, dividends, and go grab those. 46,800. Next, we're going to eliminate the stockholders' equity of our subsidiary. In this case, they did have APIC, so we'll do common stock, APIC, retained earnings, close that all into equity investment. And we'll go grab those things. Common stock, copy down to get APIC. Retained earnings is beginning of year, so we need to scroll all the way, not that far, all the way to right here, 325,000. Then we'll add these together. And I'm really not sure why my formula is delayed until I click into something else. That's very odd. Now we're on to our A entry, where we're just going to account for all of those assets that are part of our AAP. And so I don't think I put these in a way that I can nicely cell reference them. Nope, because it's like there's too much information here. So we'll just go ahead and type them. So we have the AR doesn't need to come because that's been eliminated already, but we do need to take the PPE, licenses, customer list, notes payable, and goodwill. So we have PPE, licenses, customer list, notes payable, goodwill, equity investment. And we're going to go get the unamortized amount as of the beginning of the year. So we'll take PPE, licenses, customer list, notes payable, and goodwill. Then we'll just do a quick sum and add those up for 253,825. Then we need to do our D entry, where we will do the amortization for each of these. So we're going to have our depreciation and amortization expense. Then the thing that's a little bit different about this one is that because of that note payable, instead of it's not necessarily like depreciated, it's going to actually come into interest expense. So that's, I think, different than anything we've done before. And then otherwise we can actually just grab PPE, licenses, customer list, notes payable. Okay, and so now we'll come up and grab our annual amounts. And we have the 1625 for PPE, 5200 for licenses, 6500 for the customer list, and oops, really far there, 650 for the notes payable. And then the interest expense will just reference down to the 650, and that means that obviously the depreciation and amortization is the sum of our PPE licenses and customer list only. Oops. Okay. So now we can jump into our I entries. First, we'll deal with the intercompany sales, and then the receivable, and then the actual deferred gain on the building. So let's reverse our prior year intercompany first. We'll do equity investment and COGS. And we're going to come up here. Oh, did I go way too far? I did. So we're looking for the intercompany prior year. So it's this 7,280. And just be cautious here that you don't accidentally grab the 26,000. We need to grab the 7,280 where we calculated the profit. Excuse me. Okay. Then we can do our intercompany sales for this year. So we'll do sales and COGS. Then we'll come get this 65,000. Excuse me. And then we'll finally do the eliminate the intercompany profit sitting in inventory. And when we come up, it's this 10,920. And then the accounts payable and the accounts receivable have to be eliminated for this current year. And so we'll grab the 20,800 associated with 2022. And now we need to take care of the intercompany gain and the depreciation. So we'll do equity investment in our PPE. And we'll go get the gain as of this point. So this is the unconfirmed beginning of year gain is 19,500. And then the depreciation, PPE, depreciation expense. And we calculated this as 3,250. And so now that we have all of those updated, there it comes. Okay. We can go ahead and post those to our worksheet. So I'm going to pause the video, post all mine to the worksheet, and then we'll come back together and make sure that we have the same balances. Okay, so now I have all of these posted. So you can go ahead and just do a double check and make sure that your consolidation worksheet ends up looking the same as this one. I'll zoom out so that you can have a whole picture at once. Zoom out a little more. Okay, so if you want to pause here, you can just do a double check and make sure that everything balances out.